put your hands together and welcome them to the future-proof stage.
Thank you so much for coming to our session today. We've got two great CIOs here, and I'm going to let them introduce themselves. I just wanted to tell you I'm Amy Stone. I'm with Barron's, and I run our Barron's Advisor section of the website. And it's free to anybody who registers for the Barron's Advisor experience. So please, anyone in the industry can register. Or if you subscribe to Barron's, you can read everything for free. So that's who I am, and I'd like to invite our panelists to introduce themselves.
Sure, howdy. I'm from Texas. That's how we start things. I'm also from Texas A&M, if anybody else understands the how. No, okay, moving on. My name's Victoria Grain. I'm CIO of G Squared Private Wealth. We're an RIA based a little north of Houston, Texas, and I'm not here to sell you anything. So hopefully that gives you some good unbiased advice from this panel.
Hi, everyone. I'm Rafia Hassan. I'm Chief Investment Officer at Paragon Wealth Management. We are an RIA firm. We lead with financial planning, holistic wealth management, headquartered in San Francisco. We have offices across the country in about 17 different locations, close to $10 billion of assets under management.
Great. And so this panel, we've got the CIOs here, but we're mostly going to talk about the investment platforms. If you want to hear their views on the markets and stocks, we can definitely hit those questions at the end. But for now, let's jump right in with kind of the big question, which is, how do you basically, as CIO, set up an investment platform that can scale but also provide custom solutions for clients that want them? Do you want to start, Victoria?
Sure, and bear with me because I'm about to use an analogy. But when I was a kid, my dad's an engineer, and there was like a big car accident, and I asked him, why can't we build safer cars? And my dad looked at me and he was like, of course you can build safer cars. But when you're building a car, you have the engineer that's like, this is super safe. And then they run into the fuel economy guys and the engine guys, and they're like, oh, this is super fast. So then the engineer and the engine guys, they argue, and they have to come to a compromise. And then you get the design people, and they're like, that's an ugly car. We got to make the car look nicer. So then the design people get involved. So now you have designs and engineers and all these technicians, and they come to agree, and then here comes the bean counter from the accounting side. They're like, way too much money. Absolutely not. So all four of them have to agree to build something together, and that's how you get a Toyota Camry. Now, you can have a very fast, very safe car. I don't know if any of you guys watch Formula One, but they can crash those cars at like 200 miles an hour, roll multiple times, and walk away without a scratch. But that's going to set you back about $2 million. So as we're looking at building your tech stack, think about it like designing a car. You're going to have to make some compromises somewhere. If you want to buy the most expensive tech with all the customizations, all the bells and whistles, well, have fun paying for it. And that often doesn't fly for a lot of advisors. They want really great tools and technologies, but not if it costs them like 25 basis points or things like that. So it's always a little bit of a compromise. And in our business, our compromise is between us, cost, compliance, operations, and marketing. And it's the same type of design team. The one thing I will mention as we're looking at building our tech stack, you are married to your custodian. Of all the decisions that you make, your custodian is by far the most important, because if you divorce your custodian, that is massively disruptive. Almost anything else, it stinks to move platforms, but you can move, right? You can adjust, you can add on, you can fire someone, you can bring on new technology. Your custodian is who you marry and the most important decision you make as an RIA.
Yeah, so I love that analogy, and I'm sure I'm going to steal it at some point. Yeah, in terms of how we think about building out the investment platform at Paragon, we serve about 60 plus advisors across our firm. And each of those advisors has a slightly different client base and different needs. So when I think about our investment platform and how we've built it out, it's like we want to optimize, not always for efficiency, but we want to optimize for what it is that's going to serve those client needs the best. And what that means is in terms of how we think about the platform, we have certain portfolios that are model portfolios, but then we're working with multiple different asset managers across the industry to customize those model portfolios. So we have some that have more of like a tactical approach, others that are more long-term strategic. And so it's about having solutions that are going to meet the needs of the advisors that we have across the firm, while at the same time, ensuring that we're able to do it in a way that is cost efficient. And so what that means is making decisions about what it is that we're going to do in-house, where is our time best spent. And one of the areas that we do have an in-house solution is when it comes to direct indexing, and that's something that we're able to do really well in-house. But then there's other things where we are leveraging partners, and that's what enables us to be able to provide more solutions across the platform that meet a diverse set of needs across our advisor base.
Okay, great. And maybe we'll do a quick, because you mentioned custodians, like a quick lightning round on who do you custody with, and do you have more than one?
Yeah, we're multi-custodial with Schwab and Pershing. And Pershing has two different sides of it, the PIS and LLC, and that's pretty important. I would candidly say, if you're looking at Pershing, and sorry, I know BNY is pretty close to here, but be looking at the LLC side. The PIS side is kind of not where they're growing as much tech stack. The LLC's drive is being driven by Wove, and they're investing a lot in it. But I definitely think they're important. Schwab's been great because they finished their acquisition, and they've got all the tools they've got. They've got iRebal and everything else. So I think Schwab's also a pretty strong custodian for us.
Yeah, we work with about 5+ custodians, including Schwab, Fidelity. Those are just some of the larger ones. But in addition to that, we have relationships with Pershing, with Axos, SEI, LPL. So we are definitely multi-custodial. That comes with some pros as well as cons. On the pros side, I would say, we've grown a lot via acquisition. And so working with that many custodians means that, if an advisor comes to us, they don't necessarily have to repaper all of their clients, and it's much more seamless, less relearning for them and their team. However, from a con standpoint, I would say is that, operationally, it does make things more challenging for our ops teams, for our trading team. We do have centralized trading. And so one of the things that's been really helpful is we work with Orion for the portfolio management system, and they have a fixed flyer connection with each of the different custodians. So we are able to trade using Orion and connect with the different custodians, and that makes things much more streamlined from a trading standpoint. From a client service standpoint, many of the teams that are joining us, they're used to working with the custodian that they've been with, and so because of that, it makes it a little bit easier there. I will say though, we have certain designated subject matter experts for various different custodians, and that helps us keep things a little bit more streamlined.
What's the AUM you would take to open with a new custodian? I assume there's some limit that you would be like, no, I'm sorry, but no.
Yeah, we wouldn't start a new relationship with, I think we have most of the major custodians covered at this point. so
if you find another one, let me know.
I know. I'm like, who else is out there that we could possibly be working with? I also forgot to mention, we do also custody with Goldman Sachs, so I don't want to. So I would say it would be at least like a couple $100 million that we would need on a platform to consider starting a relationship with a new custodian. But again, I feel like we've got our bases covered at this point. I can't think of who else is out there that we would need to custody.
Yeah, that sounds like good advice. So it sounds like the advice is basically add custodians, but realize it's going to add complexity to the CIO's office to manage all those relationships, and you need an in-house expert probably for each one. Anything else you want to add to that, Victoria?
I think it's the data feeds and linking everything in that's the hardest part. End of the day, obviously you need to be able to support it, but everybody is super difficult about data feeds, and that is probably the hardest part of this job. Is everything sounds great on paper, and everybody's like, yeah, let's work together, we'll set up, let's add this manager, or add this TAMP, or add this tech, and then you get into the weeds of okay, cool, how do we actually do this? And they're like, no, I don't really want to send that data feed, or we're not set up to send that data feed, or we actually want you to work with this tech stack because this data feed's established. And so that's probably, I think, the hardest thing is that custodians get super, I get it, they also need to be scalable in their operations, but they don't want to work with just every single piece of technology out there. And so that would be the one thing, and I'm sure I sound like an old fuddy-duddy because this is future-proof, but as you're looking at all this new future technology, realize not everybody's set up to work with it yet and not integrated yet. So I think the one question you need to ask, do you have an existing relationship actually set up Not we're in negotiations or we're talking to them or this or that, but do you have an actual data feed relationship set up with this custodian on this side? Because some of these custodians have like multiple different parts of their business. So they'll be like, oh, sure, we work with Schwab, but not really Schwab Advisor Solutions. We just meant like this little bit over here that you can't access. So I think all of this tech is amazing, and there's going to be so many opportunities down the road. But the number one question I would ask them is, do you actually currently physically work with this custodian?
Yeah, okay. I think that's really important because I can't tell you how many times I've heard, oh, that's on the roadmap, or that's going to launch next quarter, and then next quarter rolls around, I'm like, hey, what's going on with that? And it's like, yeah, I think maybe next quarter.
Yeah.
That's the story of my life. It's coming. It's next quarter, 100%, 90 days, absolutely going to be live.
Okay. No, that's great. Thank you for that. I did want to bring it back to the clients because that's sort of working with the tech providers. What about when clients come over with an advisor and they have, a unique need or something that you haven't encountered and they want to fit it in? How do you deal with that?
Well, one would be the hope you can map it to something existing. Use tax overlay, use direct indexing, long short, something on platform to help them transition out of it. If it is truly something, for us, it's a couple $1,000,000 to add a new strategy. Like, we're not going to onboard some SMA strategy because some dude's got 250K. Sorry, just not going to happen. But you've got a couple $1,000,000 or it's core to your business. So I think there's a limit because people don't understand onboarding a manager isn't just about, okay, here's the data feed, here's the contract, here's the fees. It's the due diligence. We as a firm take a lot of responsibility. If something goes wrong and this manager, makes some horrible decisions or they start straying from their mandate, it's up on us to make sure we're actually doing due diligence. So it's not just paperwork, negotiating fees, getting them on platform, getting the data feeds, and getting everything set up. It's also about, do we feel comfortable with this manager? Do we feel confident in this investment? The biggest thing I always ask is do you actually do what you say you're going to do? Right? If you're a downside protection manager, cool, I want to see actual numbers. And that gets harder because so many new products are coming out and I'm going to tell you this, I have never, ever, ever seen a bad back test, ever. Everybody's got a great back test. Everybody's investment works. Trust me, don't worry, it'll work. Look at these back tested numbers and think about how many investments have blown up or not come through or not done anything. So for me, again, fuddy-duddy, I like to say 3 years of actual operations and numbers, and then I'll consider you. I don't really want something new and groundbreaking because unfortunately I've seen it go wrong too many times. And while that can be frustrating for some advisors, at the same point I'm we're also taking some responsibility here to provide you with a platform that we've done due diligence on. I think the one area I've bent on a little bit is crypto funds because we've had to provide a solution. You have to have a theme and understand crypto, and honestly, quite frankly, you need to be able to say, yes, you can solicit and buy crypto or else your advisors are going to leave. I mean, I bet and things like that. But even that took compliance agreeing that we could tell our advisors that they could go out and solicit crypto.
Rafia?
So when we're looking at acquiring new firms, one of the things that we're always doing is investment due diligence. It's like a standard part of our process where we'll have the teams that are thinking about joining us send us a list of all of their investments, what are the holdings in them, and then I'll do a holistic review of everything, make sure that I'm comfortable. And there might be certain things that come up that I'll have additional questions on. In terms of what do you do when it's something that you can't get comfortable with, right? And there's a couple of different avenues there. One is to think about, okay, what's the sizing of this investment relative to the overall portfolio? And is it something that we could potentially manage around over time, right? Because a lot of times what happens nowadays is you have investments that have tons of embedded gains, right? And I think that's the number one fear that I hear from advisors that we're talking to. We're thinking about joining another firm or bringing their book of business over. It's what are you going to do about my existing client portfolio with embedded gains? Are you just going to turn the entire portfolio over and cause a bunch of taxable gains? And my answer to that is always absolutely not. We're going to think about this and we're going to work together collaboratively on it. Now, if it's a situation where it's something that just cannot get comfortable with, I think in that in that scenario, it might be something where we would carve that out and not bill on that portion of the assets.
I also think there's always an exception to the rule. If you're big enough, or we want you enough, or the client's big enough, there's the will and a way. But I also tell my advisors, I'm like, you get 1 or 2 chips a year. You can't come running to me every month being like,
right.
One time, swear to God, last time I'm going to ask for. It's like, it's really got to be, hey, this guy's got 10 million in NVIDIA and we need a solution, or we're really looking for opportunity fund zone or alternatives, and I feel like you've got to have something that checks every box. Like, do you have a way to do 1031s on alts? That's usually a pretty common way of like, hey, I need that solution. Do you have private credit? You got to have like 6 private credit, and you got to have an interval fund or this or that. So I feel like you got to build your menu. Now the thing is, it might be like, going to the grocery store and they don't have Honeycrisp apples, maybe you're going to have to take like a Gala apple. Sorry, Honeycrisp is, by the way, still the best apple, but I mean, it's the same thing, right? Like, you're going to have to convince them that this is an equivalent, like, let's go through the numbers, like, and then, alts are also difficult to move depending on where it comes from. If you come from a wires are phenomenal at that master feeder structure where they're really trapped. They're not really in that fund. You're in a feeder fund, which, oh, by the way, happens to be proprietary to a Morgan, a Merrill, and sometimes you got to be like, those will wind down, these are movable, here's this. But it's providing that roadmap, providing those options, and making sure our menu is robust enough that they feel comfortable that, one, we're always looking, right? And I'm always looking. You want to talk to everybody, like, I want to hear every idea you've got. Just because I don't pull the trigger doesn't mean it's not a good idea. It might mean I've got something similar on platform and you're not unique enough. Might be, I think you're insane, so no. And it might just be like, I don't really have a need for it. It's too niche, and it's not worth the process to onboard it. And they're not looking. Nobody wants to onboard and get like 20K in AUM. They want to onboard and have a decent relationship with you.
Great. Rafia, what about crypto? Do you guys have a policy on that, and what do you think?
So we have certain crypto ETFs that we've approved that advisors can use. In terms of allocation, and going back to my earlier point on how we think about that, like, our suggested allocation is 1% to 2% of a portfolio, not necessarily more than that. And so, that's how we think about it. It's not part of any of our model portfolios, and that's an ongoing discussion. Do we explicitly want to add it there to some of those investment strategies? But if a client requests it, or some of the advisors will, they'll have their own portfolio strategies and they want to add it, that's not an issue.
We created like a digital asset capstone model. So it's meant as like to UMA it with another asset allocation model. So it's not meant to be a standalone necessarily. And there's multiple ways you can look at crypto and digital assets. You have, honestly, if you're doing crypto publicly traded, you're looking at Ethereum and Bitcoin, some sort. If not, you're looking at kind of the next gen fintech digital asset support things. So either it's ETFs, which is something we're more comfortable with of some of the fintech ETFs and the crypto ETFs, or you're building an individual, which we have not, but I'm sure they're going to come down the road of it's all the ones that from strategy to Coinbase to Hood to everything else that's involved in the crypto atmosphere. But we thought that was a neat solution of don't really want to add it to our models because you got some guys that honestly we've gotten feedback from our advisors. Some clients are like, it's a scam. Absolutely not. If this touches the account, like, I'm firing you. So we had to give the option of, here's an availability. You can use it to wrap around an existing allocation model, but it's not required to be part of the model. So that for us was kind of, we thought, a neat and tidy way of giving options, making sure they're aware of what funds are in there, but not making it mandatory for asset allocation models.
Great. Well, I wanted to shift a little to the compliance question, which we had talked about when we met earlier. How do you work with compliance, and what kind of advice do you have? I'm sure crypto comes up. I'm sure AI comes up. A lot to discuss.
You have to be patient with compliance. That's their job. Their job is to say no, and it's a miserable job. And so I try to be very understanding. It doesn't mean I don't push back quite frequently and but they've lived it. Think about the different eras a lot of this have been through. You had multiple firms that got the pantsuit off of them coming off the tech bubble because they allowed too much stuff happening inside portfolios and they didn't do due diligence. Compliance's job is to make sure you don't get the pantsuit off of you if things go wrong. Hopefully compliance never has to do that because everything's fine. But if something blows up, like circa tech bubble or 2008, everybody got sued over having companies going bankrupt, or more on the fixed income side with bonds going bankrupt. That's the compliance's job, is to say, have you considered if this goes really, really wrong, what's going to happen to you? And that's their job. So sometimes you have to take a step back and realize you need a strong person in that role that's saying no. Now, we need them also to say yes sometimes. So again, it comes into what kind of chips are you going to cash? And for us, it was like, you got to let everybody solicit crypto, IBIT and Ethereum or whatever that may be. Like, we have to allow that on platform. But we understand that we have to have some limitations. We make everybody take a cryptocurrency training. There's an extra form to sign. Like, how can we protect ourselves from this going wrong and still provide the avenue? So compliance is necessary evil, and it's their job to say no. And I think that just I think people have to have an appreciation. It's a terrible, horrible job, but a necessary one.
Rafia, your turn.
So our chief compliance officer is also our general counsel. He's a lawyer, and so we work very closely and collaboratively together. And I mean, I think that one of the things that I most appreciate is that he's able to articulate sometimes what the regulatory issues are with something that we want to do. It's not just like no, it's yeah, but have you thought about this? It's very much a conversation, and it's not just somebody who's always saying no. It's instead someone who's asking questions and trying to understand what's the business or investment angle that we're trying to solve for versus what are the regulatory risks that we have to consider. And so I think that it works pretty well. I think, sometimes he says yes to things that I really want, and sometimes, there's certain things that we just aren't going to do. And so it's a relationship that's built on trust, I think, over time and through multiple different interactions. So I think, we end up in the right spot.
I think it's a difficult job in this market because things are moving so fast. Think about in the last 12 months how many single stock leveraged ETFs have been launched, or and those are like the new hot thing. How quickly crypto's moved, how quickly there are now new crypto ETFs. And compliance kind of loves to look and check their box and say, what's the track record, what's people and company, and it's moving quickly. So I do think compliance is trying hard. I think they're in a very difficult job because you do have all this stuff coming down the pipe. And again, if you think about the number of lawsuits that came out of the tech bubble of 2008, anytime there's a massive market event, there's lawyers circling saying, did you provide proper disclosure? Were they aware of the risk of this investment? And and they're looking. They're always looking. So compliance's job with legal is to protect you. Compliance has a very hard job because things are moving so fast. And quite frankly, and sorry again, fuddy-duddy, but I'm like, some of these single stock leveraged ETFs are very dangerous. And that's where you have to be careful of what's an acceptable risk. We got to have something for publicly traded crypto. Absolutely. You need to have some sort of Bitcoin, Ethereum readily available. And what might be a little bit too dangerous right now, and I would say, quite frankly, a 3x single stock leveraged ETF is one that I wouldn't want my advisor soliciting because that has lawsuit written all over it in a bear market.
Yeah. Well, we're already starting to get some questions in, which is great. I wanted to just ask one more so we hit a few areas. But what do you do, and then we'll go to the questions. What do you do when you have an advisor who isn't, getting on board with the program in terms of working with new technology or adopting your models and things like that? How do you manage that?
Yeah, so I'm happy to take that one. So in terms of advisors and technology adoption, I think one of the things that's most important to recognize is a really great advisor is going to be somebody who's good at managing client relationships. That does not 100% jive with the Venn diagram of being somebody who's technology savvy. And recognizing that, I think, is really important, and trying to meet people where they're at. Now, there's some technologies at our firm that are absolutely core to our business, and we want to make sure that advisors are adopting them. So, for example, using Orion as our portfolio management system, or using Salesforce for CRM. Those are things that we want all the advisors that are working with Paragon to use generally. And so when you encounter that situation, I think it's figuring out, not necessarily making the advisor learn to use the technology, but providing them the support that they need to be able to use the technology in a way that, is what we need as a firm. And so that's how we approach it. We try to be flexible where we can, but certainly there are certain things that we want advisors to use. And then it's like, okay, if it's a really successful advisor, you don't want them spending their time, in the CRM system trying to figure out how they put in their notes, right? Like that's probably not a great use of their time.
Right.
Culture is key. So one, making sure you're bringing the right people on, having a plan of somebody next gen that can understand technology. That's probably the biggest divide when we have firms that are trying to pass on to next gen, and next gen wants to move forward, and the senior advisor's like, no, this is the way it's done. It's always been done, and then that's causing friction. So some of it's training, some of it's like candidly, just be careful who you're bringing in. And then the third, and I mean this very lovingly, you can't fix stupid. So like if you're going to bring somebody in that doesn't understand technology, unless they're really ready to hand off the book and you have a succession plan and you're ready to get them over here and get them out as quickly as possible, the potential they become kind of infect the firm with their malaise is key. So I look at that and say, are you willing to be flexible? Are you willing to learn? I'm not going to force you to have to use like Jump AI or other tools, but you can't also inhibit the younger advisors on your team potentially from moving forward with technology. And that does cause friction, because the older one's like, I built this book, and this is how it's done, and this and that. Graded, 100%. Absolutely. Get the credit. You're getting paid for this. But you need to let the book advance. You need to let your younger advisors run the book in a more efficient manner, utilizing tech and AI, and you cannot like kind of force them to be like handwritten notes.
Yeah, that's a great point. I think that sort of onboarding new teams and evaluating new teams, that's a good thing to look at. All right, let's go to the questions. We have one here. How should CIOs balance being portfolio architects with being business strategists driving firm-wide growth? That's a great question. Rafi, do you want to jump in with that?
Sure, yeah. So I think you need to be able to do both. Obviously, when you think about the title, Chief Investment Officer, it's definitely, you think of somebody who is going to be more focused on portfolios and building out those portfolios. But with that said, I think one of the biggest downfalls of some great CIOs that I've come to interact with is they fall in love with an investment product that's super complicated, isn't going to get adoption across the firm, but they love it so much. And I think that that's something that you have to be aware of, because where and how you're spending your time. Are you spending your time on things that are really value add for the firm, or things that are satisfying your intellectual curiosity or your desire for coming up with a really super complex product, right? Because there's a lot of products out there that advisors just don't want to take to their clients. So one of the things that I focus on a lot is getting feedback from our advisors anytime we're thinking about introducing something new to the platform. And many of the best ideas that we have are things that advisors have brought to us, things that they were doing in their book of business that we were then able to take out and communicate to the rest of the firm and garner adoption on. And then they're the ones who are also champions of that strategy to the other advisors and saying, hey, this works really well for my book of business. So it's not just Rafi is telling me this is a good idea. It's like, oh, well, Rafi thinks it's a good idea, and this other advisor has found great success with that strategy in their book of business. So I think listening is a really key skill in this role, particularly as you're thinking about larger firms. And the second part of it is communication, because many times you have to communicate something multiple times before it really resonates.
Yeah, that's great advice.
I think for me, it's what do I need to touch versus what can my team help take care of, and that you have to be a bit mercenary on what my time is and what we're offering and what we're promising. Obviously, we're here to help advisors grow. We're here to help the firm grow. But end of the day, if you suck at investing money, then that's the number one problem. So I'm like, keep your house in order. Make sure your portfolios are good. Make sure that you're taking care of that and you're hitting the marks you need to hit. And then also, part of the role of a CIO is external, right? You're either marketing for the firm, you're marketing to help your FAs grow, you're running an event, you're doing a webinar or something like that. So for me, though, it's mercenary. Like, I have to be very honest what I can and cannot do. But at the end of the day, I'm like, I also can't suck at my primary job. So I take that pretty seriously.
Great. Well, we're down to the last 30 seconds or so. Just as a quick end lightning round, is there one piece of advice you'd give the audience about, setting up the investment platforms at your firm?
Do your due diligence. Take your time. I know this is move fast, break things, blah, 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 but take your time.
I would say don't be afraid to ask partners for help. I think that's one of the things that I've found most valuable over the last couple of years is just asking for, from your asset managers. Like if you come across like a difficult question or you're thinking about a certain strategy that you want to build in-house, go and ask people for feedback. And there's a lot of smart people out there. And so I think there's no harm in asking for that help and seeing if maybe they're able to do it for you.
Yeah, that's great. It sounds like communication is really key to your role here. So thanks for sharing how it all works. And thanks
guys.
everyone for
Thank
coming.
you.